Welcome to Level 1 Lesson 4. My name is RIA the Trader from TradingWing.net. In this lesson, I will continue talking about investing versus trading, as in the last lesson, I mentioned a few terms you may not be familiar with. Let's start with stocks. Stocks are basically an ownership of shares of an individual publicly traded company, and it represents owning a percentage of a company. For example, if a company only had 100,000 shares available to trade and you purchased 1,000 shares, you now technically own 1% of the company. There are, however, two different types of stocks. There are dividend stocks and there are non-dividend stocks. Dividend stocks pay out a percentage of your investment back to you on a quarterly, biannual, or annual basis. Dividend stocks are typically purchased by investors and not traders. A great example of a dividend stock is 3M Co., also known as ticker symbol MMM, which currently pays an annual dividend yield of 3.31%. This yield can change, however. Let's look more into detail. If you were to invest $100,000 into 3M, your annual dividend income as of now would be roughly $3,310. However, that does depend on if the dividend yield percentage changes or if the stock price changes. If either of those factors change, your annual dividend income will also change. Non-dividend stocks, on the other hand, pay you out by having you simply sell your shares at a higher price than you purchased it. Non-dividend stocks are typically purchased by traders, and a great example of a non-dividend stock is Tesla, also known as ticker symbol TSLA. Let's look in depth in this one. If you were to purchase 1,000 shares of Tesla at $600 a share, you would only attain profit by selling those shares at a price higher than $600. If you were to sell it at a lower price, you would be losing money. Stocks are very critical as they carry a lot of uncertainty regarding your future return. As dividends are not contractual obligations, if a company chooses not to pay a dividend, there is little to no consequences. Some examples of stocks are Apple, ticker symbol AAPL, Microsoft, ticker symbol MSFT, Tesla, ticker symbol TSLA, Google, ticker symbol GOOGL, and so on. Now let's look at bonds. Bonds are different than stocks, as instead of purchasing ownership of shares, you are lending money to the issuer of the bond in exchange for your initial investment plus interest after maturity. Purchasing bonds means forming a contractual obligation with the issuer of the bond. For example, if you were to purchase bonds, the issuer must return your money, or if they don't, then they are in default, which typically follows with company bankruptcy. There are two primary types of bonds. There are government bonds and corporate bonds. Government bonds are categorized into 5 different sections. The first is federal government bonds, which hold a lower yield as the federal government has the ability to print money and collect tax revenue, which significantly lowers their chance of a default and increases your chance of getting your initial investment back, followed by a low yield interest. The second are treasury bills, which typically take a little under a year to mature. Maturity represents the time in which you will now begin receiving interest. Treasury notes take about 1 to 10 years to mature. Treasury bonds take over 10 years to mature. And finally, municipal bonds are bonds issued by local governments or states. They do, however, come with a greater risk than federal government bonds, but offer a higher yield. The moral here is that the higher the yield, the higher the risk. The lower the yield, the lower the risk. Now let's look at corporate bonds. Corporate bonds are divided into 4 different main sections. The first is a convertible bond, which allows the lender to convert their equity into stock shares. This means that if you were to invest into a convertible bond, the company may allow you to convert the money that you've invested into shares of the company. Because it provides a safety net, convertible bonds offer much lower yield. The second is a callable bond. A callable bond allows the issuer to pay their debt off to you early. The reason for this is that the market may typically experience lower interest rates or lowered interest rates. So companies will pay off their debt early to reborrow funds at a better interest rate. The third type of corporate bond are investment-grade bonds. These are bonds with a high credit rating or a credit rating of a minimum of BAA, which is considered investment grade and has little to no risk. And finally, there are junk bonds. Junk bonds are bonds that come with a credit rating of BB or lower and offer high yields due to the increased risk of company default. So again, the higher the yield, the higher the risk. Now let's look at commodities. Commodities are a marketplace for buying, selling, and trading raw materials or primary products. However, there are 2 different types of commodities. There are hard commodities and there are soft commodities. Hard commodities include natural resources that must be mined or extracted, such as gold, oil, rubber, and so on. Soft commodities, on the other hand, are agricultural products or livestock, such as wheat, sugar, coffee, pork, and so on. And finally, let's look at mutual funds and ETFs, also known as exchange-traded funds. ETFs and mutual funds are different than stocks and bonds because they are known as pooled investment vehicles. This means that money from many investors is put together into a pool to buy a collection of securities. A great example of an ETF is Vanguard S&P 500, also known as ticker symbol VOO. As you can see on the images provided below, the VOO or Vanguard S&P 500 diversifies their portfolio. You can see communication services, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, information technology, materials, real estate, and utilities. The VOO or Vanguard S&P 500's top 10 largest holdings are Microsoft, Apple, Alphabet Inc., Amazon.com, Tesla, Meta Platforms, Nvidia Corporation, Berkshire Hathaway, JP Morgan Chase & Co., and United Health Group. And that concludes this lesson.